There's no getting around it. Tesla's results from the first quarter of 2025 were absolutely terrible. And that's what we learned after the market closed on Tuesday. It doesn't look like there's going to be much of a reaction because a lot of this was expected. Even though results were worse than a lot of analyst estimates, investors were not really concerned about what was happening in the first quarter. They're thinking about what's going to happen with the robotaxi, with the Optimus robot, with new products that are going to be coming out, potentially a new lower cost vehicle later this year. But fundamentally, Tesla is a manufacturing company. Manufacturing companies need to make money on their production, on what they're making. Otherwise, they're going to go out of business. That's just the fundamental nature of manufacturing. And that's why Tesla's results were so surprising. Because when you look at the decline in revenue, the decline in margins, Tesla would be losing money if it wasn't for the fact that they could sell regulatory credits. And those credits are becoming less and less valuable. On top of that, we haven't seen an impact of tariffs yet, but management said that tariffs are going to have a huge impact on the one bright spot that we have with Tesla. That's the energy business. I'm going to dig through all this today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. Thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Before getting to the segment results, let's just look at the overall numbers. This is the first financial summary that Tesla reports. You can see that the top line is really the most important here. Revenue from the auto business was down 20% year over year to $14.0 billion. The decline was even worse if you compare it to the fourth quarter, when the fourth quarter revenue was $19.8 billion. So management talked about the first quarter is always bad. We upgraded the Model Y, so that was a really big accomplishment. But the end of the day, Tesla's demand declined sharply in the first quarter. That ultimately hurt their margins as well. But let's go through this energy storage business. That was up 67%. I'll get to that in just a second. And some of the comments that management made about the potential impact of tariffs on that energy business. But overall, total revenue was down 9% in gross profit. There's that operating leverage that we get with a manufacturing company, down 15%. The other pretty notable thing here, operating expenses were actually up 9%. Tesla's done a really good job not increasing those operating expenses all that much, but they're spending more and more money on artificial intelligence, on developing their humanoid robot, the Optimus. That's going to end up in the operating expense line. So that means there's negative leverage on operating income. That's why operating income was down 66% in the quarter to just $399 million. You can see that their operating margin was just 2.1%. That is going to be worse than basically every other automaker in the first quarter. Now, the reason results were as bad as they were is because they're simply selling fewer vehicles. You can see that in the detailed numbers here. The Model 3 and Model Y production was down 16%. Deliveries were down 12%. Overall, deliveries were down 13% in the quarter. And this is very much a Tesla-specific problem. This is the results that we've seen from General Motors. We don't have the full results in their revenue and operating income and things like that, but we do have their delivery numbers. Deliveries were up 17% in the first quarter of 2025 to nearly 700,000 vehicles. Electric vehicle sales, look at this bottom right. Electric vehicle sales were up 94% in the quarter to 31,887. That's fewer than Tesla is selling in the US, no doubt, but they are growing, and they are growing as Tesla is losing market share. Even in China, General Motors reported positive comps with 442,000 units sold in the quarter, and their new energy vehicles was up 53%. That includes their electric vehicles. If you move over to Ford, you see the exact same thing as you see with GM. Total electrified vehicles up 25% in the first quarter. Fully electric vehicles were up 11.5%. And what's gaining market share? Hybrid vehicles. Their total vehicle sales were down slightly, down 1.3% in the quarter, but that's nowhere near the decline of 13% that we saw from Tesla. But we're getting to the point where Tesla's numbers are really concerning because they're subsidized by automotive credits, regulatory credits. You can see that here on the far right. In Q1, $595 million of regulatory credits were sold. That compares to net income for the quarter of $409 million. That means without those credits, Tesla would have lost money in the quarter. Here's another way to look at it. This is their gross margin excluding credits. And you can see that has declined from 26.8% at the end of 2021 down to just 6.6% in the most recent quarter. So Tesla, at the end of the day, is an auto manufacturer, and their auto business is getting weaker. The fundamentals are getting weaker. Demand is going down. Their pricing power seems to be completely gone. And by the way, competition is taking market share. All of this can be waved away by Elon Musk on conference calls, but the reality of the market is Tesla is just not the operator that they once were, and that premium that they've deserved in the market just doesn't seem to be deserved anymore. So almost all of the value that we have in the company today is based on these products that don't yet exist. Things like the robotaxi, fully autonomous driving, Optimus robots. But the auto business particularly in the state that it is today, is not very valuable because it is losing market share and the margins are getting worse, potentially even losing money if those regulatory credits decline.
Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now.
But let's also look at the energy segment as well. This is the energy segment's revenue and gross margin. You can see that this looks phenomenal. Just great growth from Tesla Energy. What they're not discussing here and what they don't give a lot of disclosures of is what the subsidies Tesla gets based on the Inflation Reduction Act. You will notice that the gross margin changed dramatically after the Inflation Reduction Act passed. Tesla was one of the main beneficiaries because, yes, they're importing most of their cells from China, but they're assembling them into battery packs. And so they get subsidies depending on how many packs they're producing. That has actually led to higher demand and higher margins in the US. That's really what's driving the profitability of this segment. Again, they don't really disclose exactly what those subsidies are, but that's going to be a huge driver. And they do get most of their batteries from China. This was the comment on the conference call. The impact of tariffs on the energy business will be outsized since we source LFP battery cells from China. We're in the process of commissioning equipment for local manufacturing for LFP battery cells in the US. However, the equipment can only service a fraction of our total installed capacity. So it's very possible that if these tariffs stay in place, particularly the tariffs on China, that is going to have a massive impact on Tesla's revenue and margins for the energy segment, which is really the only bright spot we see. Now, I'm not even going to get into things like FSD and the rollout of robotaxis, what they're going to launch in Austin, because I think there's a lot of talk there. But until Tesla actually does something, until they actually have a fully autonomous vehicle that is unsupervised, that doesn't have a safety driver in the car, and we actually get hundreds of thousands of miles on the road, proving that they are actually safer than a human driver, that's not a business that I'm going to put a lot of value on. And I know that investors think about that very differently, but there are companies today like Waymo, like Mobileye, like May Mobility, who are doing the front end testing. We're putting tens of thousands, if not millions of miles on the road, proving that their systems are safe and that fully autonomous robotaxis are something that they're going to launch in the relatively near future over the next couple of years. Waymo is obviously launched. May Mobility is doing the same. Mobileye is one that I've invested in because I think they are going through the legwork both in the US and in Europe to actually launch that at scale with a number of different manufacturers. Tesla has not even started that testing. And that's something that Elon Musk talked about, is that you need to do hundreds of thousands, if not millions of miles worth of testing to even prove that you are safe enough to find out what those long tail risks are. And they haven't really done that work yet. So until they do that and they prove that FSD can operate without a driver in the car, that isn't a business I'm going to put a lot of faith in or a lot of value in. When the numbers are this bad, it's telling you that Tesla is in a really tough position. This isn't just about what Elon Musk is doing with the government. This is about their vehicles. This is about their manufacturing. This is about their cost structure and the demand that they have right now. The market's still putting a lot of value on products that don't yet exist. But I think ultimately Tesla has proven that it's not the leading automaker or manufacturer that we thought it was a few years ago. It has not held on to those high margins. And this is really a pandemic story. They took advantage of the pandemic, raised their prices, increased their margins. And now when we get to a more competitive environment, Tesla is not looking nearly as good as it was just a few years ago. I think that's what we learned from the results today. But let me know what you think. Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.